There is a ghost in the machine of modern capitalism, an invisible saboteur that has dismantled more fortunes and bankrupted more companies than any recession, war, or market crash. It is a force celebrated on the covers of magazines, praised by market analysts, and chased relentlessly by executives and entrepreneurs. This force is innovation, and for the vast majority of investors, it is a death trap. We are taught to seek out the new, the disruptive, the groundbreaking. We are told that the future belongs to those who can predict the next technological leap, the next paradigm shift, the next company that will change the world. And so we pour our hard-earned capital into businesses promising to reinvent transportation, to revolutionize data, to redefine communication. We buy the story, we chase the hype, and in doing so, we step directly into a minefield. The relentless pace of change doesn't just create winners. For every victor, it leaves 100 corpses in its wake. The very excitement that draws us in is a signal of immense, often fatal, risk. The landscape is littered with the bones of once innovative giants: Blockbuster, Kodak, Nokia, MySpace. These were not poorly managed companies. They were titans, leaders in their fields, who were simply on the wrong side of an inevitable future. The retail investor, caught in the crossfire, saw their dreams of portfolio growth and financial freedom turn to dust, their capital gains evaporating into permanent losses. But what if there were a way to sidestep this minefield entirely? What if the secret to exceptional long-term investing wasn't about predicting the future, but about identifying the parts of the world that refuse to change? What if the key to beating the market was not to find the next great innovator, but to find the last great survivor? This is the core philosophy of the man who has compounded wealth more successfully than anyone in human history. Warren Buffett, the Oracle of Omaha, has built an empire of hundreds of billions of dollars, not by guessing what the world will look like in 2050, but by understanding what will look almost identical to today. He has achieved this through a single, deceptively simple question. A question so powerful it acts as a filter, separating the fleeting fads from the permanent businesses, the speculative gambles from the certainties. He looks at a business and asks, how has this industry changed in the last 10 years, and how is it likely to change in the next 10? This one question is the key to his entire system of risk management. It is the genesis of every durable competitive advantage he has ever purchased. It is a tool that forces a forward-looking perspective, transforming your stock analysis from a reactive guess to a proactive strategy. By the end of our journey today, this question will no longer be a piece of trivia about a famous billionaire. It will be the single most powerful weapon in your own financial arsenal, the one principle that will allow you to build a portfolio designed not just for growth but for survival. Let us begin with the first and perhaps most profound pillar of this philosophy: the futility of prediction and the wisdom of inversion. The human mind is a prediction machine. From the moment we wake, we are forecasting the traffic on our commute, the mood of our boss, the outcome of a negotiation. We are wired to look forward and guess what comes next. Wall Street has built an entire industry on this impulse. Armies of analysts produce intricate models forecasting quarterly earnings, interest rate movements, and technological trends. They create the illusion of control, the sense that the chaotic, unknowable future can be tamed and put into a spreadsheet. The retail investor consumes this information voraciously, believing that the key to getting rich is to be smarter at the prediction game than the next person. Buffett's genius lies in his total rejection of this game. He recognized early on that the future is fundamentally unpredictable. He knew he couldn't predict the internet, the smartphone, or artificial intelligence. And more importantly, he knew that he didn't have to. Instead of asking what is going to change, he inverted the question. He started asking, what is asterisk not going to change? This simple flip is the foundation of his wealth. It is a conscious decision to trade the exciting, chaotic world of prediction for the boring, profitable world of permanence. The foundational anecdote that cemented this principle in Buffett's mind, the transaction that served as his personal Rosetta Stone for value, took place in 1972. It wasn't a sophisticated tech company or a complex financial instrument. It was a box of chocolates. The company was See's Candies, a beloved West Coast confectioner. At the time, Buffett and his partner Charlie Munger were still largely operating under the cigar butt philosophy they had learned from their mentor, Ben Graham. They looked for statistically cheap companies, often mediocre businesses, trading at a price so low they could get one last puff of profit out of them. See's was different. It was a good business, but it wasn't statistically cheap. The asking price was $30 million against tangible assets of only about $8 million. Munger, a brilliant mind in his own right, initially balked. The price was 3 times book value. It violated the core tenets of classic Graham-style investing. But Buffett saw something deeper, something that didn't appear on the balance sheet. He applied his emerging mental model. How has the business of selling chocolate changed in the last 10, 20, or even 50 years? The answer was, almost not at all. People enjoyed high-quality candy as a gift and a personal indulgence. They associated the See's brand with quality, nostalgia, and happiness. It was a simple, emotional transaction. Now the crucial second half of the question, how is this business likely to change in the next 10 years? Again, the answer was, very little. No new technology was going to render chocolate obsolete. No internet startup was going to digitally disrupt the experience of giving your Valentine a heart-shaped box of candy. The brand, which produced feelings of warmth and trust in customers, was an intangible asset of immense value, a moat that protected the business from competition. Buffett realized they weren't just buying machinery and inventory, they were buying a piece of their customers' minds. They were purchasing a business whose future was, to a very high degree, knowable. They paid the $30 million. This decision was a watershed moment for Berkshire Hathaway. See's went on to generate over $2 billion in pre-tax profit for Berkshire over the years, requiring very little additional capital investment. But its true value was the lesson it taught. It rewired Buffett and Munger's approach to capital allocation. It taught them that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The fairness of the price was determined by the certainty of its future. See's Candies, in all its delicious simplicity, was the ultimate proof that the most profitable predictions are not about what will change, but about what will endure. The reason this inverted approach is so powerful and so difficult for most people to adopt lies deep within our cognitive architecture. Our brains are plagued by a host of biases that push us towards the See's Candies antithesis, the exciting, fast-changing, and ultimately fragile business. The first culprit is the availability heuristic. This is our mental shortcut that relies on immediate examples that come to mind. When we think about wealth creation, the stories that are most available, the ones plastered all over the news and social media, are about explosive growth in tech stocks. We hear about early investors in Amazon, Google, or Tesla. These vivid, high-profile examples make it seem like this is the primary or even the only way to achieve financial freedom. The quiet, steady compounding of a company that makes paint or sells soda simply doesn't make for a good headline. It's not available to our minds, so we underweight its probability of success. We are drawn to the noise of innovation, not the silence of durability. Compounding this is the commitment and consistency bias. Once we buy into a narrative, especially if we have invested money in it, we feel a deep psychological need to remain consistent with that decision. An investor who buys a speculative biotech stock because of its revolutionary new drug will actively seek out information that confirms their thesis and ignore data that contradicts it. They've committed to the story of a changing world, and to admit that the story is flawed is to admit they made a mistake, which is psychologically painful. They become wedded to the prediction. The inversion of Buffett's question shatters these biases. By asking what won't change about the candy business, you are forcing your brain to ignore the noise. You are deliberately sidestepping the sensationalist stories of disruption and focusing on a more boring but more reliable set of facts. You are not betting on a single, low-probability outcome, a new drug getting approved. Instead, you are betting on the high-probability continuation of a basic human desire, the enjoyment of candy. This mental discipline is a form of cerebral risk management. Its short circuits our innate and often financially disastrous wiring to chase novelty, and instead directs our attention to the stable foundations upon which true long-term wealth is built. So how can we translate this powerful, abstract idea into a practical tool for the retail investor? The blueprint is a mental model I call the certainty ledger. It's a simple pen and paper exercise that forces you to apply Buffett's inversion to any potential investment. Take a blank sheet of paper and draw a line down the middle. On the left column, write the heading, "Things I am 90% certain will be true about this business and its industry in 10 years. In the right column, write, "Things I am less than 50% certain about." Now let's apply this to two hypothetical companies. First, a hot new software company that provides data optimization services using a proprietary AI algorithm, let's call it Data Future Inc. On the left side of your ledger, what can you write with 90% certainty? You might write, "Businesses will still want to optimize their data." That's probably it. Now look at the right column, the uncertainties. Will Data Future's current algorithm still be cutting edge, or will a competitor have leapfrogged it? Will their main client base, say e-commerce firms, have been disrupted by a new form of social commerce? Will the entire field of data science be transformed by quantum computing? Will the company's brilliant founder and CEO still be at the helm? The list of profound, business-altering uncertainties is staggeringly long. Your right column will be overflowing. Now, let's do the same exercise for the Hershey Company. What can you write in the left column, the 90% certainties? People will still enjoy chocolate and candy. The Hershey's brand will still be recognized and trusted globally. People will still buy candy as an impulse purchase at checkout counters. The basic desire for a sweet treat is a fundamental part of human psychology. The list of certainties is long and robust. Now what about the right column, the uncertainties? Perhaps there will be a new fad diet that discourages sugar. Perhaps cocoa prices will fluctuate. These are manageable business risks, not existential threats. You will struggle to fill the right column with anything that could truly destroy the company. The certainty ledger gives you a stark, visual representation of the predictability of a business. A long left column and a short right column indicates a business with a knowable future, a durable competitive advantage. A short left column and a long, terrifying right column is the signature of a speculative gamble. This is not about being a Luddite, it's about being a realist. Before you invest a single dollar, this simple blueprint will force you to confront the difference between a business you can understand and one you are simply hoping works out. It is the first step in moving from a gambler's mindset to an owner's mindset, which is the cornerstone of all successful long-term investing. To truly appreciate the power of this model, we must dedicate some time to its antithesis, the path of the 99%. This is the road most traveled in the world of investing, and it is paved with good intentions and terrible returns. The archetype of this path is the story stock investor. This individual is captivated by narrative. They don't invest in businesses. They invest in tales of a glorious future. A decade ago, this was the investor who poured their money into 3D printing companies. The story was intoxicating. Every home would have a 3D printer, revolutionizing manufacturing from the ground up. They bought stocks like 3D Systems or Stratasys at astronomical valuations, convinced they were on the ground floor of the next industrial revolution. They didn't ask the hard, inverted question. They didn't create a certainty ledger. If they had, they would have seen that while the idea of 3D printing was powerful, the future of the specific companies, their profit margins, their competitive landscape, was a complete unknown. The industry underwent massive change, commoditization, and competition, and the stocks collapsed, wiping out fortunes. More recently, we saw this with the investor who bought Peloton at its pandemic-fueled peak. The story was perfect. The future of fitness is at home, connected, and community-driven. Peloton was the clear leader, but the 10-year question would have raised red flags. Will people still want to pay a premium for a stationary bike with a screen in 2030? Or will they have returned to gyms? Will competitors offer cheaper hardware with the same classes? Is the business model truly protected? The narrative was exciting, but the future was deeply uncertain. The path of the 99% is defined by this forward-looking guesswork. It is an attempt to predict the winner in a race where most of the contestants will not even finish. It is emotionally thrilling, a constant rush of hope and speculation. But it is a brutal way to build wealth. It mistakes technological change for durable value creation. It focuses entirely on the potential for upside, while completely ignoring the probability of the downside, which in fast-changing industries is terrifyingly high. It is, in essence, a ticket to a lottery, not a deed to a business. The direct financial connection between Buffett's inverted question and superior returns is not mystical, it is mathematical. It boils down to one of the most fundamental concepts in finance, the discounted cash flow, DCF valuation. The theoretical value of any business is the sum of all the cash it will generate from now until Judgment Day, discounted back to its present value. To perform a DCF analysis, you must forecast a company's future cash flows. Herein lies the multi-trillion-dollar insight. For a company like Data Future Inc., forecasting its cash flows 10 years out is an act of pure fantasy. The number of variables is too high, the range of outcomes too wide. Your valuation is built on a foundation of sand. Any number you arrive at is likely to be precisely wrong. Therefore, your decision to buy the stock is not an investment based on value, but a speculation based on a story. Now consider a company like the Hershey Company or See's Candies. Can you predict their cash flows next year with perfect accuracy? No, but because the business is stable and the industry changes slowly, you can project its future earnings within a reasonably narrow range of probabilities. Your DCF analysis, while still an estimate, is grounded in a far more stable reality. The financial advantage this provides is monumental. It allows you to make a rational decision about price. You can say with some confidence, I believe the future cash flows of this business are worth X, and the market is currently offering it to me for 70% of X. This is the definition of value investing. It provides a margin of safety. If your estimates are a little off, you still have a buffer. For the story stock, there is no margin of safety, because the valuation itself is a work of fiction. By focusing on businesses with knowable futures, you are playing a different game. You are systematically lowering the probability of a permanent loss of capital, which is the single most destructive force to long-term compounding. This disciplined avoidance of the unpredictable is what separates professional capital allocation from amateur speculation. It is the mathematical bridge between a good story and actual durable capital gains. This leads us directly to our second pillar, the castle and the moat, quantifying durability. If the 10-year question is the diagnostic tool, the durable competitive advantage, or what Buffett famously calls the moat, is the condition it seeks to identify. Buffett thinks of a business as a castle. The castle is the source of the profits, the engine of value. But in a capitalist economy, any profitable castle will immediately attract invaders. Competitors will see those high profits and try to take them for themselves. A moat is a structural feature of the business that protects it from these invaders. It's a ditch around the castle filled with crocodiles that makes it difficult, if not impossible, for competitors to attack. The 10-year question is the ultimate test of a moat's integrity. A moat that can be easily crossed by a new technology or a shift in consumer behavior is not a moat at all. It's a decorative puddle. A true moat must be able to withstand the siege of time. It must ensure that the business will look largely the same in a decade as it does today. Understanding the nature and resilience of these moats is the second critical layer of Buffett's analytical framework. It's how he moves from identifying a stable industry to pinpointing the specific company within that industry that is built to last. The quintessential anecdote for this principle is Buffett's monumental investment in the Coca-Cola Company, which began in 1988. By this point, Berkshire Hathaway was a major enterprise, and Buffett needed to deploy billions of dollars. He was looking for a castle of immense size with a moat that was virtually unbreachable. He found it in a glass bottle of soda. He started by applying the question, how had Coca-Cola's core business changed in the last 50 years? The product was essentially identical. The business was selling a simple, branded sugar water. How would it change in the next 50 years? Buffett reasoned that the fundamental human desire for a cold, sweet, refreshing beverage was permanent. The real key, however, was the moat. He saw that Coca-Cola's moat was not its secret formula or its bottling plants. Its moat was its brand, a dominant position in the collective mind of the entire planet. He researched the numbers. At the time, over 300 million 8-ounce servings of Coke products were consumed every day around the world. He imagined a competitor, let's say you and I, wanting to challenge Coca-Cola. We come up with a slightly better tasting cola. We even have $1 billion for marketing. We go to a corner store owner in a remote village in India and say, "Put our new cola next to the Coke." The owner would refuse. Why? Because his customers come in and ask for a Coke, not a cola-flavored carbonated beverage. The word Coke was synonymous with the product itself. This mental dominance, built over a century of advertising and consistent presence, was the moat. It was an intangible asset of almost incalculable value. Buffett saw that this brand allowed Coca-Cola to have pricing power and a global distribution network that was impossible to replicate. So, between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a significant stake in the company. The market was skeptical. Some saw Coca-Cola as a mature, slow-growth business, but Buffett saw an invincible castle. The investment has since become one of the most successful in history, generating tens of billions of dollars in dividends and capital gains for Berkshire shareholders. It was a masterclass in identifying and quantifying the durability of a moat, proving that the most powerful competitive advantages are often the ones you can't see on a balance sheet. The psychological principle that underpins the power of a moat like Coca-Cola's is social proof, deeply intertwined with brand association. Humans are social creatures. When we are uncertain about a decision, we look to others for cues on how to behave. This is social proof. When you walk into a foreign supermarket and see a wall of unfamiliar products, you are far more likely to choose the one brand you recognize. Coca-Cola, through a century of relentless marketing, has become the ultimate form of social proof in the beverage aisle. Its ubiquity is its strength. Seeing it everywhere, from vending machines to movie scenes to sports stadiums, reinforces the idea that it is the correct choice. The brand is not just a logo. It is a mental shortcut. It saves us the cognitive energy of having to evaluate every option. We trust it. This brand association goes even deeper. Coca-Cola has spent billions of dollars associating its product with positive emotions: happiness, friendship, celebration, refreshment. When you drink a Coke, you are not just consuming a beverage, you are subconsciously partaking in a cultural ritual. A competitor with a better tasting or cheaper product faces an almost impossible task. They are not just fighting against a formula, they are fighting against a century of memories, habits, and psychological conditioning. The 10-year question is a powerful tool to test the resilience of this social proof. For a company like Coke, you can confidently say that in 10 years, this deep-seated brand association will still be a powerful force. But consider a company whose advantage is based on a temporary technological edge. Its moat is based on features, not feelings. This kind of advantage is incredibly vulnerable, as a competitor can simply engineer a better feature. The psychological bond is weak. Buffett understands that a moat built on human psychology is far wider and more enduring than one built on technology alone. To make this practical, an investor needs a systematic way to pressure test a company's proclaimed moat. This is the blueprint I call the moat erosion test. It's a proactive exercise in pessimistic thinking, designed to reveal the vulnerabilities in your own investment thesis. Step 1. Clearly identify and define the company's primary moat. Don't just say brand. Be specific. Is it a luxury brand based on exclusivity, like Ferrari? Or a low-cost brand based on ubiquity, like Coca-Cola? Is it a network effect, where the product becomes more valuable as more people use it, like a credit card company? Or is it a cost advantage, derived from scale, or a unique process, like Geico's insurance model? Write it down in a single, clear sentence. Step 2. Brainstorm 5 specific, plausible technological, cultural, or regulatory shifts that could happen in the next decade. These should not be generic fears, they should be concrete scenarios. For example, if you are analyzing a railroad company like BNSF, your list might include 1. The rise of autonomous, long-haul electric trucking. 2. A major political shift towards breaking up monopolies. 3. A dramatic decline in coal consumption, a key cargo. 4. A new pipeline technology that makes transporting oil cheaper. 5. A cultural shift towards localized manufacturing that reduces the need for long-distance shipping. Step 3. For each of these 5 scenarios, write a detailed paragraph explaining how it would impact the company's moat. This is the critical step. Don't just state the threat, analyze its mechanism. How exactly would electric trucks erode the railroad's cost advantage? At what price point for electricity and batteries would the crossover occur? How would the loss of coal revenue impact the fixed costs of the entire network? This exercise forces you to become the company's adversary. You are actively trying to breach the castle walls. If, after this rigorous attack, you find that the moat holds strong against most plausible threats, you have identified a truly durable competitive advantage. If your scenarios easily crumble the moat, you have likely found a business whose best days are behind it. This blueprint transforms stock analysis from a passive act of cheerleading to an active, critical process of risk management. The path of the 99%, the antithesis, is littered with investors who mistook a temporary advantage for a durable moat. The perfect case study is Research in Motion, the maker of the BlackBerry. In the mid-2000s, BlackBerry looked like it had an impenetrable moat. It had a beloved product with a famously addictive physical keyboard. It had a powerful network effect through its BlackBerry Messenger (BBM) service, a secure, proprietary system that was the gold standard for business communication. Its market share was dominant, and its brand was synonymous with productivity and professionalism. An investor in 2006 could have easily concluded that RIM was an invincible castle. But if they had applied the 10-year question and the moat erosion test, the cracks would have appeared. The moat was purely technological. It was not rooted in a deep, unchanging human behavior. A scenario brainstorm might have included, what if a competitor creates a touchscreen that is good enough for typing? Or, what if messaging services become app-based and work across different devices, destroying BBM's closed network? These were not outlandish sci-fi scenarios in 2006. The technology was already emerging. The launch of the iPhone in 2007 was not a black swan event. It was the realization of a plausible threat that a disciplined analysis would have identified. The 99% of investors who owned RIM were focused on its current dominance and past performance. They saw the strong castle walls and failed to notice that the ground beneath them was technological quicksand. Contrast this with a classic Munger investment like Wrigley's Gum. What was the plausible threat that could disrupt the chewing gum business in 10 years? A new flavor? A different packaging? These are trivial. The fundamental business was utterly stable. The investor who focuses on today's market share and last quarter's earnings is looking in the rearview mirror. The Buffett-style investor uses the 10-year question to look through the windshield, scanning the horizon for the technological and cultural tidal waves that can wash away even the mightiest seeming castles. The direct financial connection between a durable moat and portfolio growth is measured by a key metric, return on invested capital, or ROIC. Imagine two businesses. Business A is in a fiercely competitive industry, like airlines. To stay competitive, it must constantly buy new planes, slash ticket prices, and spend heavily on marketing. It requires enormous amounts of capital just to stay in the game. Even if it generates profit, its return on the capital it has invested is low. Business B is a company with a strong moat, like a dominant brand of toothpaste. Its brand and distribution network are already established. It doesn't need to reinvent its product every year. It can generate high profits with very little additional capital investment. Its ROIC is consistently high. A company with a durable competitive advantage is a financial machine that produces high returns on the money it employs. When you analyze a company's financial statements, looking at a long history of high and stable ROIC is like getting a quantitative X-ray of its moat. It's the numerical evidence that the business is protected from the ravages of competition. This has a profound impact on shareholder returns. A company with a high ROIC has options. It can reinvest its profits back into the business at that same high rate, creating a powerful compounding effect. Or, if there are no good reinvestment opportunities, it can return the cash to shareholders through dividends or share buybacks. Both of these actions directly lead to the growth of your own portfolio. Companies without a moat are stuck on a capital-intensive treadmill, reinvesting heavily for meager returns. A business with a wide moat is on an escalator, effortlessly generating excess cash year after year. This is the tangible financial result of the abstract concept of a durable competitive advantage. It is the engine that drives long-term capital gains and the foundation of true wealth management. This brings us to our third pillar, a concept that is less about analysis and more about personal discipline, the too hard pile, intellectual honesty, and the circle of competence. The logical conclusion of applying the 10-year question is that for the vast majority of businesses, especially those on the cutting edge of technology, the question is impossible to answer. The future is a chaotic fog of unpredictable variables. Acknowledging this fact is not a sign of weakness, it is the hallmark of a world-class investor. Buffett's secret weapon is not a crystal ball, it is a wastebasket. He calls it his too hard pile. If he cannot, with a high degree of confidence, picture what an industry will look like in 10 years, he doesn't spend 5 more minutes on it. He simply puts it in the too hard pile and moves on. This requires a level of intellectual honesty and humility that is almost non-existent on Wall Street, an industry that profits from the pretense of knowledge. For Buffett, investing is not about solving the most difficult puzzles, it's about finding the easy ones and betting heavily on them. This discipline of knowing what you don't know is the ultimate form of risk management. The most powerful foundational anecdote for this pillar is not a successful investment, but a multi-year period of deliberate, disciplined inaction. I'm talking about the late 1990s and the height of the dot-com bubble. The market was in a frenzy. Any company with .com in its name was soaring to astronomical valuations, regardless of its business model or profitability. It was a new paradigm, the experts claimed. Old metrics like earnings didn't matter anymore. It was all about eyeballs, clicks, and growth. During this period, Warren Buffett became a figure of ridicule. He was on the cover of Barron's in 1999 with the headline, "What's Wrong, Warren?" The article portrayed him as a dinosaur, an old-fashioned investor who didn't get the new economy. He was dramatically underperforming the market. His shareholders were restless. The pressure to abandon his principles and join the tech party must have been immense. But Buffett's response was simple and unwavering. He publicly admitted that he did not understand these new business models. He could not look at a company like Pets.com or Webvan and answer his fundamental question, what will this business look like in 10 years? He didn't know how the internet would evolve, which companies would gain durable market share, or how they would eventually become profitable. Because he couldn't answer the question, he did nothing. He put the entire tech sector into his too hard pile. He was willing to look foolish in the short term to avoid being ruined in the long term. Then, in March of 2000, the bubble burst. The Nasdaq, filled with the tech darlings of the era, went on to lose nearly 80% of its value over the next 2 years. The companies that were supposed to change the world simply vanished, taking trillions of dollars of investor capital with them. Buffett, by having the discipline to say "I don't know," had preserved his capital, weathering the storm completely. His adherence to his circle of competence, his willingness to use the too hard pile, was vindicated in the most dramatic fashion imaginable. It was a lesson in the immense financial power of intellectual humility. The psychological trap that Buffett so skillfully avoided is known as the Dunning-Kruger effect, combined with a powerful dose of overconfidence bias. The Dunning-Kruger effect is a cognitive bias, whereby people with low ability at a task overestimate their ability. In the context of investing, it means that the less someone knows about a complex industry like biotechnology or semiconductor manufacturing, the more likely they are to believe they can successfully pick winning stocks within it. The dot-com bubble was a national festival of the Dunning-Kruger effect. Day traders and novice investors, armed with a brokerage account and a sliver of knowledge, suddenly believed they were technology analysts, capable of predicting the future of the internet. They were, in the parlance of psychology, unconsciously incompetent. Buffett, on the other hand, operates from a state of conscious competence. He is a true expert, and a key trait of expertise is an acute awareness of the limits of one's own knowledge. His too-hard pile is a formalized system for managing this. It's a direct antidote to the overconfidence that plagues most investors. The average person feels a pressure to have an opinion on everything. If a stock is in the news, they feel they must decide if it's a buy or a sell. Buffett feels no such pressure. He understands that his financial success is not dependent on the number of great ideas he has, but on the quality and certainty of a very small number of ideas. By refusing to play in games he doesn't understand, he is sidestepping the psychological minefield of overconfidence, where most investor portfolios go to die. It's a profound realization. In investing, your ignorance, when honestly acknowledged, can be a far greater asset than your intelligence misapplied. How can a retail investor build this same discipline? The blueprint is a mental model called the competence filter. It's a simple three-step triage process to apply before you even begin analyzing a company's financials. Step 1. Define your circle. This requires introspection. Take out a piece of paper and write down the industries you understand on a professional or deeply personal level. Are you a doctor? Then you have a massive head start in understanding healthcare companies. Are you a software engineer? You understand the tech landscape better than 99% of Wall Street analysts. Are you a lifelong obsessive gamer? You have an intuitive grasp of the video game industry. Be honest and specific. Your circle of competence is likely smaller than you think. This list is your hunting ground. Everything else, by default, is on the periphery. Step 2. The 5-year-old explanation. Before you do any deep research on a company, even one within your circle, you must be able to pass this test. Can you explain, in simple terms a child could understand, exactly how this business makes money and why it will still be making money in 10 years? For example, for a railroad, they own giant metal tracks all over the country. Big companies pay them to move heavy stuff on their trains from one place to another. It's cheaper than trucks for heavy stuff, and it's too expensive for anyone else to build new tracks, so people will keep using them. If your explanation involves jargon, complex technology, or vague promises of future profits, you have failed the test. The business is too complex. Step 3. The triage. This is the final, crucial step. If a company is outside your circle defined in Step 1, or if it fails the 5-year-old explanation in Step 2, it goes immediately into your personal too-hard pile. No exceptions. Don't read an analyst report about it, don't look at its stock chart, don't feel bad if it goes up in price after you've dismissed it. This is about building an unbreakable discipline. The goal of the competence filter is not to find investments. It's to eliminate 99% of potential investments, leaving you with a small, manageable universe of businesses that you can truly understand and analyze with confidence. The antithesis of this disciplined approach is the FOMO investor, driven by the fear of missing out. This investor's portfolio is not a curated collection of well-understood businesses, but a chaotic scrapbook of market fads and headline-driven purchases. They hear their friends talking about a cryptocurrency that's skyrocketing and they buy in. Without understanding blockchain technology, they see a stock like Nvidia on a tear and they pile in, without a clue about the competitive landscape in the semiconductor industry, the cyclicality of demand, or the company's valuation. Their investment process is purely reactive, triggered by the emotion of greed and the fear of being left behind. They are the polar opposite of Buffett. Buffett sits patiently, waiting for a fat pitch in the middle of his strike zone. The FOMO investor swings wildly at every pitch, no matter how far outside the strike zone it is. The defining characteristic of the FOMO investor's portfolio is that they cannot pass the 5-year-old explanation test for any of their holdings. They own a collection of black boxes. They might be able to tell you the story or the stock ticker, but they cannot tell you, in simple terms, about the durable competitive advantage or the long-term earnings power of the underlying business. This is not investing. It is gambling on price momentum. It can work for a while in a bull market, creating the illusion of genius. But when the tide goes out, as it always does, the FOMO investor is left exposed, holding a portfolio of overhyped, poorly understood assets whose prices collapse back to their intrinsic value, which is often close to zero. The direct financial connection of the too-hard pile is its role in managing what statisticians call tail risk. In a normal distribution, most events cluster around the average. But in financial markets, there are fat tails. This means that the probability of extreme catastrophic events, a stock going to zero, a market crash, is much higher than a normal bell curve would suggest. The success of a long-term investing career is often defined less by picking the occasional 100-bagger and more by rigorously avoiding the investments that have the potential to be a zero. These are the companies that suffer a permanent loss of capital. By systematically placing businesses with unpredictable futures into the too-hard pile, you are methodically cutting off the left tail of your potential outcomes. You are refusing to play the games that have a small but real chance of a catastrophic loss. When you invest in a company like Coca-Cola or See's Candies, the probability of your investment going to zero is vanishingly small. When you invest in a speculative biotech firm whose future hinges on a single FDA trial, the probability of it going to zero is very real. This disciplined avoidance is the most potent form of risk management available to any investor, from the small retail player to the multi-billion-dollar fund. Over a lifetime of investing, avoiding the big mistakes is more profitable than chasing the big winners. The too-hard pile is your single greatest tool for mistake avoidance, directly preserving your capital so that it can continue to compound for decades to come, ensuring your path to financial freedom. This logically flows into our fourth pillar, the compounding power of boring. The natural outcome of applying the 10-year question and adhering to your circle of competence is that you will find yourself drawn to businesses that Wall Street and the financial media find utterly uninteresting. Paint, bricks, insulation, furniture, railroads, insurance. These are not the companies featured in flashy presentations about the future. They are the backbone of the economy, the providers of essential, unchanging goods and services. The investing world is obsessed with growth, often confusing rapid revenue expansion with a good business. Buffett's approach reveals a more profound truth. Predictable, moderate growth in a stable, profitable business will create far more wealth over the long term than explosive, unpredictable growth in a cash-burning startup. The magic is not in the growth rate itself, but in the relentless, uninterrupted power of compounding, which only works when a business survives and thrives for decades. The boring businesses are, more often than not, the greatest survivors. A wonderful foundational anecdote for this principle is the story of Buffett's purchase of the Nebraska Furniture Mart in 1983. It is a tale that encapsulates the beauty of a simple, durable, and decidedly boring business. The company was founded by Rose Blumkin, a legendary Russian immigrant known to everyone as Mrs. B. She had built a colossal, single-store retail empire in Omaha based on a simple philosophy: sell cheap and tell the truth. Her store was a chaotic, sprawling behemoth that massively undersold its competitors. How did Buffett find this gem? He was a customer. He saw the manic crowds, the incredible sales volume, and the fierce loyalty Mrs. B commanded. He applied his question: how has the way people buy furniture changed in the last 50 years? They want a wide selection, they want to see and touch the product, and they want a low price. How will it change in the next 50 years? Probably not much. The internet didn't exist in 1983, but even today, while some people buy furniture online, many still want to sit on a couch before they buy it. The business model was durable. The deal itself was pure Buffett. He went to meet the 90-year-old Mrs. B, and without looking at any audited financials, he asked her a few questions and made a deal on the spot. He wrote a check for roughly $60 million. The purchase was based on his understanding of the business's durable model and his immense trust in the integrity and talent of its management. It was as far from a high-tech venture capital deal as one could imagine. And the results? The Nebraska Furniture Mart has since expanded to several massive locations and does billions of dollars in sales annually. It has been a phenomenal compounding machine for Berkshire Hathaway shareholders for 4 decades. It is the perfect example of how a boring, well-run business, bought at a fair price, can generate spectacular long-term returns, far outstripping more glamorous investments that capture the public's imagination but ultimately fail to deliver lasting profits. The underlying psychological principle that makes boring so powerful is what is known as the paradox of choice. Coupled with a fundamental human craving for simplicity, we live in a world of overwhelming complexity and choice. Modern life bombards us with options for everything from our morning coffee to our streaming services. This often leads to decision fatigue and anxiety. In this environment, boring businesses often thrive because they provide simple, trusted, and reliable solutions to recurring problems. When you need to paint a room, you are not looking for a disruptive new paint technology. You are likely to go with a trusted brand like Sherwin-Williams. When you want a piece of chewing gum, you'll grab a pack of Wrigley's, a product that has been virtually unchanged for a century. These businesses solve a simple need, and they do it consistently. Investors, however, often fall for the opposite psychological pull. They are seduced by complexity, believing that a complex product or business model must be more sophisticated and therefore hold the secret to higher returns, or alpha. They get excited by intricate technological roadmaps or convoluted financial engineering. This is a profound mistake. The true, sustainable alpha is often found in the predictable earning streams of simple, easy-to-understand businesses. The world changes, but the need to paint your house, insure your car, or ship goods by rail does not. The simplicity that makes these businesses boring to a speculator is the very source of their long-term strength and predictability to a genuine investor. To find these boring gems in your own life, you can use a practical blueprint called the Decade-Proof Daily Habit Scan. This is a 1-week exercise designed to open your eyes to the multitude of durable businesses you interact with every day. For 7 days, keep a small notebook or a note on your phone. Your task is to log every single product or service you use that your grandparents likely used in some form as well. This forces you to filter out the new and focus on the enduring. Your list might include the brand of coffee you drink, Maxwell House, the toothpaste you use, Colgate, the soap in your shower, Dove, the insurance on your car, Geico or Progressive, the bank that holds your mortgage, the railroad that shipped the package that arrived at your door, Union Pacific or BNSF, the electricity that powers your home. At the end of the week, you will have a surprisingly long list. Now, for the second step. Go through that list item by item and apply the 10-year question. For Colgate toothpaste, is it highly likely that people will still be brushing their teeth with a similar product from a trusted brand in 2034? Yes. For your car insurance, is it highly likely that people will still be required to insure their vehicles? And will they still seek out low-cost, reliable providers? Yes. This list is not a buy list. It is a boring but beautiful watch list. It is the starting point for your stock analysis. It grounds your investment search in the real, tangible economy of recurring needs, rather than the ephemeral, speculative economy of future promises. This simple exercise can completely reframe where you look for opportunities, shifting your focus from the crowded, noisy marketplace of tech stocks to the quiet, profitable world of everyday life. The antithesis to this approach is the growth at any price investor. This individual is addicted to a single metric, top-line revenue growth. They will eagerly buy shares in a company whose sales are growing at 50% per year, while completely ignoring the fact that the company is burning through mountains of cash, has no clear path to profitability, and operates in an industry with no barriers to entry. Their portfolio is full of companies that are disrupting industries, but the disruption itself is not creating a durable, profitable enterprise. Think of the legion of food delivery services a few years ago. They were all growing revenues at a staggering pace, but they were also engaged in a brutal price war, spending fortunes on marketing to acquire customers with no loyalty. They were destroying capital, not creating it. The 10-year question would have been impossible to answer. Which service would survive? Would any of them ever achieve sustainable profitability? The same is true for many innovative hardware companies, like the scooter companies that littered city streets. High growth, no profits, and a completely unknowable future. The growth at any price investor mistakes activity for progress. They are so mesmerized by the rapidly spinning top line that they fail to check if the business has an engine underneath. The boring, profitable company, perhaps growing at a steady 6% per year, looks pedestrian by comparison. But that 6% growth is real, profitable, and sustainable. The 50% growth of the cash-burning disruptor is often a mirage, a temporary land grab that will end in bankruptcy or massive shareholder dilution. The direct financial connection that makes boring beautiful is the mathematical magic of dividend growth and reinvestment. Boring, mature, and profitable companies are often veritable cash geysers. Because they are not in a hyper-competitive, fast-changing industry, they do not need to pour every single dollar of profit back into speculative research and development or cutthroat marketing campaigns. They have excess cash, and they often return this cash to the owners of the business, the shareholders, in the form of dividends. A dividend may seem small, perhaps 2% or 3% of the stock price per year. But over time, it becomes the secret engine of wealth creation. When you reinvest those dividends, you are buying more shares of the company. Those new shares then earn their own dividends, and the process begins to accelerate. It is the power of compounding in its purest form. Let's take a simple example. An investment in a speculative, non-dividend-paying growth stock that goes up an average of 7% per year will simply grow at that rate. But an investment in a boring, dividend-paying stock that grows its underlying business at 4% and pays a 3% dividend, which is then reinvested, will also return 7% in the first year. But in the second year, you are earning that 7% on a larger base of shares. Over 20 or 30 years, the difference in total return becomes astronomical. The dividend acts as a powerful, non-stop accelerator for your capital. This reliable stream of income, reinvested over decades, is one of the surest paths to financial freedom. It is a feature rarely found in the exciting story stocks, but is the defining characteristic of the boring but beautiful businesses that Buffett's philosophy naturally uncovers. Finally, we arrive at our fifth pillar, the innovator's dilemma as an investor's filter. This is where we turn the entire concept on its head. So far, we have focused on using the 10-year question to avoid the victims of disruption. But we can also use it as a sophisticated lens to analyze the disruptors themselves and, more importantly, to understand why even today's greatest, most innovative companies are perpetually at risk. This pillar is about using the seminal theory of Harvard professor Clayton Christensen, the innovator's dilemma, as a proactive screening tool. The theory posits that great, well-managed companies often fail precisely because they do everything right. They listen to their best customers, they focus on improving their existing products, and they invest in innovations that promise higher margins. This very process creates an opening for a disruptive innovator to enter the market with a cheaper, simpler, and initially inferior product that appeals to a new or overlooked segment of the market. The incumbent ignores the disruptor because it's not a threat to their core business, until it is. The 10-year question, when combined with this framework, allows an investor to see this pattern playing out and avoid becoming the collateral damage. While Buffett famously shunned technology stocks for decades, his massive recent investment in Apple provides a fascinating and nuanced case study for this pillar. For years, Apple was squarely in Buffett's too hard pile. It was a hardware company in a rapidly changing industry. Asking what the iPod or even the early iPhone business would look like in 10 years was an impossible task. So what changed? Buffett finally invested in Apple when he stopped seeing it as a technology company and started seeing it as a consumer products company with an unbreachable moat. He applied the 10-year question to the Apple of today. How is the smartphone industry likely to change in the next 10 years? The form factor of the phone might evolve, but its central role as our primary interface to the digital world is a near certainty. And this is where the moat becomes clear. Apple's true product is not the iPhone, it is the iOS ecosystem. The App Store, iCloud, Apple Music, iMessage, these services create incredibly high switching costs. A person with years of photos, music, and apps invested in the Apple ecosystem is highly unlikely to switch to an Android device just to save a few $100s. The iPhone has become a utility, a non-negotiable part of modern life for billions of people. Buffett waited until the chaotic, innovative phase of the smartphone wars had settled, and a clear, durable winner with a powerful psychological and economic moat had emerged. He didn't bet on the innovation. He bet on the sticky, predictable, annuity-like revenue stream that the innovation ultimately created. He used the concept of the innovator's dilemma in reverse, waiting until the dilemma had resolved itself and the market had matured into a stable, profitable oligopoly. It demonstrates that his principles are not anti-technology, but pro-certainty. The psychological principle at the heart of the innovator's dilemma is status quo bias. This is our innate preference for the current state of affairs. Any change from the baseline is perceived as a loss. For the managers of a large, successful company, the status quo is highly profitable. Their entire incentive structure is built around protecting and incrementally improving their existing business. When a disruptive technology appears, it is often of lower quality and has lower profit margins. To embrace it would mean cannibalizing their profitable existing products. The status quo bias kicks in, and they dismiss the new technology as a toy that their best customers don't want. This is exactly what happened at Blockbuster. Their best customers wanted a wide selection of new releases available in a convenient retail location. They were not asking for a limited selection of older movies to be sent through the mail. So Blockbuster's management, listening to their customers, focused on improving the in-store experience. They ignored the inferior mail-order model of a small startup called Netflix. For an investor, the 10-year question forces you to break free from this same status quo bias. You have to actively ask, is there a cheaper, simpler technology on the horizon that the company's current best customers don't want, but a new, emerging market might? This question forces you to look beyond the company's current P&L statement and consider the asymmetric threats that are often invisible to both the company's management and the average investor. To operationalize this, we can use a blueprint called the disruption audit. This is a checklist to use when analyzing any market-leading incumbent. It's a way to systematically apply Christensen's theory to your own stock analysis. Question 1. Who are the company's current most profitable customers, and what do they value most? Be specific. For Kodak in its heyday, it was families who wanted high-quality photographic prints for their albums. They valued color accuracy and clarity. Question 2. What new, seemingly inferior technology exists that serves a niche market the incumbent is ignoring? For Kodak, this was early digital cameras. The resolution was terrible, they were expensive, and you couldn't easily get prints. Kodak's best customers didn't want them. But they served a new market, people who wanted to share photos instantly via email. Question 3. Could this new technology, with a few more years of Moore's Law or other predictable improvements, become good enough to steal the incumbent's core market? The answer for digital photography was a resounding yes. As resolution improved and prices fell, it became good enough for everyone, and Kodak's film business, its castle, was rendered obsolete. Applying this three-question audit to any dominant company forces you to think like a disruptor. It's a powerful tool for identifying hidden vulnerabilities, in what might look like an unassailable business. It could have saved investors from the collapses of Blockbuster, Kodak, and countless others. The antithesis is the investor who buys the best-of-breed incumbent without ever considering the nature of innovation itself. This investor equates great company with great stock and fails to see that the two are often tragically decoupled. They bought Sears in the 1970s because it was the undisputed king of retail. They bought Nokia in 2005 because it was the world's most dominant and innovative mobile phone maker. They bought General Motors for decades because it was the largest car company on the planet. Their analysis is based entirely on past performance and current market dominance. They are committing the cardinal sin that the 10-year question is designed to prevent. They are driving by looking only in the rearview mirror. They failed to understand that the very factors that made these companies great, their focus on their existing customers, their vast infrastructure, their established processes, became the anchors that prevented them from adapting to a changing world. The 99% of investors see a big, profitable, well-known company and feel a sense of safety. The disciplined, forward-looking investor knows that in industries susceptible to technological change, size and history are not assets, they are often liabilities. They understand that today's market leader can easily become tomorrow's cautionary tale. The ultimate direct financial connection here is the concept of terminal value. When a professional analyst builds a discounted cash flow model to value a business, they typically project cash flows for 5 or 10 years, and then they have to estimate the value of all the cash flows from that point into the infinite future. This lump sum is called the terminal value, and it often accounts for a huge portion, sometimes more than 50% of the company's total calculated worth. The calculation of terminal value rests on a critical assumption that the company will be a going concern forever, growing at a slow and steady rate. The 10-year question, especially when viewed through the lens of the innovator's dilemma, is a direct and brutal assault on this assumption. For a company facing a plausible disruptive threat, like Kodak in the 1990s, the terminal value is not a small, steady growth number. The terminal value is, effectively, zero. The business is not a going concern into perpetuity, it is on a path to extinction. For a business like Wrigley's Gum or See's Candies, the assumption of a long and profitable future is far more reasonable, and the terminal value calculation is therefore more valid. This single insight is the difference between a sound investment and a catastrophic value trap. A cheap-looking stock, based on current earnings, can be incredibly expensive if its future earnings are going to disappear. By asking the 10-year question, you are performing the most crucial gut check on the single most sensitive and important input in a company's entire valuation. Getting this right is the essence of long-term risk management and the key to preserving and growing your capital over a lifetime. You have made it to the end of this deep analysis, and the very fact that you are still here, that you invested your time and your focus, says something profound about you. It signals that you are not part of the 99%. You are not looking for a hot stock tip or a get-rich-quick scheme. You are here to acquire the mental tools of the world's greatest masters of capital. The tool you have just been given is not merely a piece of investment advice. It is a complete paradigm shift. It is a filter that allows you to tune out the distracting noise of the market and focus on the one thing that truly matters, the durability of a business. This question, how has this industry changed in the last 10 years, and how is it likely to change in the next 10, is now yours. It is a weapon against hype, a shield against speculation, and a compass that will always point you toward the types of businesses that build lasting, generational wealth. But it is crucial to understand that this powerful tool, as complete as it may seem, is just one node in a much larger network of mental models that constitute a truly bulletproof financial mind. The system Warren Buffett uses is not a single trick. It is an interconnected lattice of principles, each one strengthening the others. You have just mastered the art of identifying a durable business. But what is the right price to pay for it? How do you factor in the quality of management? How do you think about market fluctuations and the psychology of fear and greed? These are not separate questions. They are the next links in the chain. The video that is now appearing on your screen is not a random recommendation. It is the next piece of the map. It is the model that connects directly to the one you have just learned, building upon its foundation and adding the next layer of sophistication to your decision-making process. So the choice you face right now is not simply whether to watch another video. It is a decision about who you want to become. Do you want to remain a tourist in the world of finance, collecting isolated facts and trivia? Or are you ready to continue the ascent, to assemble the complete mental arsenal required to achieve true financial sovereignty? The path of the 99% ends here. They have their interesting fact for the day and will now click away to something else. But for those who are serious, for those who are committed to mastering this craft, the journey continues. The next piece of the puzzle is waiting. Click and continue your transformation.